purpose is to support academia. So everything on the endowment side is first like do no harm and tends to be risk mitigating. And then within that, you're trying to do the best returns that you can get.
Welcome to The Derivative by RCM Alternatives. Send it.
Hi, this is Dave Morehead, CIO of the Baylor University Endowment, and we're here to talk alternatives and institutional investing on the derivative.
How are you, Dave?
Fantastic.
Good. You're down there in Waco?
Yes.
I have never been. Give us the quick down and dirty on Waco.
Yeah, Waco is 100 miles south of Dallas and 100 miles north of Austin. So in my wife's vernacular, we're about as far away from civilization as we're allowed to be.
Isn't that whole Austin to San Antonio is just becoming one big megalopolis, right? Like you think the same thing will happen in 50 years of that whole all the way out to Waco and
It
back?
is. Yeah, Austin to San Antonio, as you mentioned, is pretty built up all along I-35. There's in Texas, we talk about the triangle. It goes from Dallas to San Antonio over to Houston, back up to Dallas. We think, our office thinks, that what has gone on from Austin to San Antonio is likely to occur from Austin to Dallas.
Hmm.
And
Which is
Waco's right in the middle of that.
got it. And what you're Texas born and raised?
No, Chicago area,
Not at
born
all.
and raised. Moved to Texas in 2011 to take a job here with the Baylor Endowment and have been here since.
Right. Where'd you go to high school?
Wheaton North.
Wheaton North. All right. I thought our partner at RCM, Paul Rieger. I thought you might have been a St. Ignatius guy like my Paul and my son's there now.
Yeah, my wife and I were both Falcons.
Wheaton North Falcons. Love it.
Exactly. We were part of the DVC, so it was always the DVC versus the Catholic League.
What was the DVC? I don't even know.
DuPage Valley Conference.
Got it.
It was the DuPage Valley Conference versus the Chicago Catholic League, and a lot of basketball and football events.
What was your sport?
Tennis.
Tennis. Nice.
Yeah.
So how did you make it down to there? They were looking for someone smart, came calling up here.
It was more an inquiry from me to actually endowments kind of across the country. My wife and I had grown up, lived, worked, gone to school in the western suburbs in Chicago. And when my daughter was, my eldest daughter was in second grade, she was asking if she was going to see me in the morning. The answer was no. I was working at hedge funds at the time, and we were off to work and whatever before the kids woke up. And that started a line of inquiry of like, did I want that to be the case? Did I want to do something else? And that sort of, snowballed into, at that point in time, I think I'd been on the for-profit investment management side for 17, 18 years. And the question was, did I want to hit the repeat button on anything that I had done up to that point, or did I want to do something new? It wasn't anything particularly that I'd done that I wanted to do for like the next 25 years. And so we opted for something new. Investigated the endowment space broadly, and ended up here. If you had told me 15 years ago that I would be living in Waco, I would have said that you need to get your head checked. But yeah, the first time that we were here was the first time that my wife had been to Texas. She saw the inside of our house here 1 hour before we closed, and we're still married. So
yeah, that worked out.
Apparently I did something right.
And my warped brain doesn't hear the sweet story about spending more times with your kids. I hear like, "Ooh, hedge fund. Which hedge fund?" So, which hedge funds? What were they doing?
Yeah, so let me take you back a little bit further, as you're in the Chicago area, so you know some of these. So I worked at First Trust right out of school, and then from there did derivatives risk management at the old CRT. At the time, it was Nations Bank CRT,
Yeah.
that subsequently merged with Bank of America, of course. And so I was sitting on their derivatives platform, which was in the Sears Tower at the time, and then went from there to William Blair. I was doing sell side equity research on transportation logistics and then specialty retail. Went from there to Ritchie Capital, working for a fellow that I had worked with at the bank. And then after 4 years there, I think there was a group of us that spun out and started our own firm called Highview Capital, where we
Hmm.
were trading energy specifically. I was there for about 6 years before moving south.
All right. So you were on you were on prop firms, option traders, equity
Yeah,
firms.
and there wasn't a plan there. That was just kind of where my interests led. I will say that being in this seat, where you oversee all of those types of strategies and trading practices, has been extraordinarily helpful. So I haven't traded metals, I haven't traded softs, but I've traded almost everything else in the marketable space. So I cover marketables here. My colleague Renee covers private investments for us here at Baylor, and we pretty much have like a sibling relationship. So
Hmm.
um, we talk a lot. We're always talking about marginal dollars. Should it go to the public side or the private side? What return characteristics or potential does she have versus what I'm seeing? And so, yeah, she prosecutes the private side, and I look after the public stuff.
You're showing your age with First Trust and Sears Tower, two names that technically don't exist anymore, but
That's
we
true.
still call our office is right across from what we still say is Sears Tower. Like, come on.
Yeah, yeah,
Willis, whatever, Willis Tower. I think they lease 2 floors and get to call it the Willis Tower.
right.
That doesn't seem right. And what was your favorite part of all those stops? The energy trading seems the most
I
interesting,
mean
exciting.
I to
And you were
me,
hanging your own shingle a little bit.
yeah, to me, trading the energy space is the hardest thing that I've done. I mean, you basically have to keep track of three different things that are going on. You have to know what the economy is doing, you have to know what the market's doing, and then you have to know what individual companies are doing. And so, if all of those things are aligned and headed up, then energy tends to go up. But there are more variables that come into play there, I found, than say
Yeah.
specialty retail, where that's really a U.S. economy thing, right? How are consumers feeling, and are they buying more? Are they buying less? That one, to me, is a little bit easier to ferret out. I would say the thing that was interesting with all of it was the ability to do new things and learn new things. My kids sometimes, I don't know, I'm always last to sort of figure out what's going around, what people are saying, but sometimes they'll be like, so what's your toxic trait? If I had one, it would be that I get bored easily.
Your kids ask you what your toxic trait is?
Yeah, or they're like in the
Love those
conversation,
kids. Yeah.
they're like, yeah, my toxic trait is this. And they're like, Dad, what's yours? Well, I've got
But
five.
so they don't mean it like a trade. They mean it like you're in your life. Yeah.
Right, right.
Got it.
So yeah, I in all of those, it was beneficial to me to step into something new that I didn't previously have experience with, learn it, develop, grow, conceptualize it, and basically when I kind of get to that point, then I'm ready for the next thing.
So Baylor comes calling. You get the job there. Um, that's interesting to me. So you guys think of the world in marketable and privates totally, even if there's asset class overlap?
We do, because our view is that things are better prosecuted on one side or the other. I don't subscribe to the seems to be a belief or a practice that if it's private, it's necessarily better. than
Mm.
on the public side. I think that there are a lot of issues potentially on the private side that haven't yet gotten, brought to the fore or sorted out. And sometimes people neglect to consider. And so private to us is something where you have to think long and hard because you're giving up liquidity. And it's not really the liquidity that you're giving up that is the problem. The problem is that you're giving up your optionality going forward. So once you make a commitment in a drawdown vehicle, that's a contracted cash flow that when they call, you have to send it. But of course, whenever they're calling capital, that may not be the best use of capital at that point in time. And so necessarily whenever you are signing, subscriptions papers for a private investment, you're selling a strip of options. And I think that most people don't think about it that way. And
Right,
that
you're
that
short
that
like an opportunity
yeah,
cost call, basically,
exactly.
right?
Right.
Yeah.
So and then you end up a little bit over your skis, and then you're in a liquidity situation. You can't take advantage when you should, and et cetera, et cetera, et cetera. It takes, 3 to 5 years to sort that out.
And then we could argue, right, that a there's not just a premium anymore, there's a discount, right? Like for the privates, right? Well, I was going to save that for later, but we could dive in now of like what Cliff Asness calls, right, volatility laundering, right? Of, hey, we're going into privates because we know they don't give mark to market. We know the marks are a little smoother. So we're going into that on purpose. I think that's what drove a lot of private equity and the
Yeah, I
premiums.
mean, if that's certainly not something that we think about, we're doing it for returns, period.
Yeah.
People are getting into an asset class for that purpose, then yeah, you're sort of asking for trouble because that's not the point of investing in privates. Investing in private should get you higher returns, but you need to take into account all of the kind of sold options
Yeah.
that you have.
But do you think they maybe not explicitly, but implicitly in the numbers and look at the Sharpe ratio or whatever, the volatility's lower, this is a better investment? Or what you were saying before, we don't really think of it as better or worse. It's just different.
Yeah, yeah, it is different, and our threshold is to the tune of like 500 basis points annualized over whatever the public market comp is. So if it doesn't meet that, we don't do it.
Hmm. And you'll see that across. Do you ever come in and you're like, hey, we've got an private energy investment, we've got a on the public side energy stocks, and those have kind of a horse race internally of which one are we going to invest in?
We do that to some degree at different points in time. Typically, we either want a particular category in privates or we want it in public. So let me give you a for example, like
Yeah.
10 plus years ago, you could give money to a private equity energy midstream manager where they're developing pipelines. You could develop that for 3 to 4 times EBITDA, and then you could turn around, take it public, and the market would value it at 13 or 14 times EBITDA, right? So that was basically a private public market arbitrage, and so you should just
Hmm.
do that. That doesn't exist today, but to the extent that it did, you should be doing all of that on all of your midstream energy on the private side, right? Because that's just free money.
Yeah.
So, when situations like that exist, then we'll allocate all of the capital either the public side or the private side to take advantage of that arbitrage, if you will, between private and public markets. Um, right now, what we're doing is we're really moving a lot of the cyclical assets out of our private book over
Hmm.
to our public book. And the reasoning is because when you're signing up for private markets, you're signing up for getting cash flows back 7 to 10 years in the future. And none of us know what the economy is going to look like. We definitely don't know what crude prices are going to look like 10 years out. Same could be true with real estate, anything that's cyclical.
Yeah.
And we don't, because our purpose, our goal is so meaningful to the university. We're trying to help students go to school. Higher ed costs are going up. We're trying to create returns faster than the school is growing so that we can ultimately get to a point where, tuition increases stop and potentially go the other way. Because that's our goal, allocating capital to a strategy and then having a macro variable affect that 8 years from now. And so therefore we get 0% return on it through
Mm.
no fault of the manager.
Yeah, yeah.
That's an opportunity cost that we simply can't take. And so we're on the private side, we're allocating to categories that tend to go up and to the right over time. And then we're putting, the manager expertise on top of that. So for
Which is
your
like private credit, or what are we talking?
no, for your listeners, that would be like we're allocating to healthcare,
Mm.
tech, and consumer. We're not doing real estate, we're not doing energy, we're not doing anything that's cyclical because we don't want to be standing there 8 years from now. This is metaphorical, but we
Yes.
want to be standing there 8 years from now explaining to a student why they have less scholarship dollars because crude prices ended up at 30, right? We couldn't,
And cyclical, to me, you're saying I would call it more like
as opposed to
correlated,
a secular trend.
yeah, or like correlated to the economy or a
Yeah.
right
So we're trying to
recession.
allocate to things that have big secular trends like healthcare. Are people going to spend more money on healthcare globally in 10 years from now than they are today? Yes, of course, right?
Yeah,
Is technology going to advance over the next 10 years? Yes, of course. Is biotech going to solve more diseases over the next 10 years? Yes, of course, right? So like we want to allocate to those things where the underline is yes, of course.
right.
And then we have the manager expertise sitting on top of that.
But surely I could get 25 people, 2,500 people on here to be like, oh, we're short on housing. Housing's going to go up to the right, of course,
Mhm.
right?
You
But
could, and that's
yeah,
why there are markets, and
exactly.
they can run their own program.
But to me, you're saying not only like, sure, that's a factor, and of course, but that's got all these dangers to a slowing economy, higher interest rates, yada,
Mhm.
yada, yada, that the others are a little more insulated from.
Correct. Yeah, we don't want to take a risk that we can't forecast well.
And go back because I've never, do you think what the model you explained, so the endowment's there to drive returns to help cover all sorts of costs or mainly to provide that tuition assistance? Give me a little background on what
Yeah, I mean,
Baylor's
all
doing, and then maybe if you can, I don't know how much you know about other endowments, but how that contrasts with others.
sure, all university endowments, but almost all of them, the largest portion goes to scholarships. Whether that's 30%, 40%, 50%, almost all endowments like fall into that category. And then there's another big wedge of the pie that goes to professorships. So if a professor has a named chair, for example, the yada 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 chair
Yeah.
in, sociology or, finance or
Yeah.
whatever, those
Philosophy.
are backed by endowed dollars. And so um, programs too are sometimes funded by endowed dollars. I think that there are some schools that have actually taken this into the athletic realm, where perhaps coaches' salaries are
Mm.
funded by endowed dollars. So at the end of the
NIL.
day, yeah, well, could be. Yeah, I haven't heard a whole lot about that happening. I think it's new enough and the future direction of that is uncertain enough that everyone is doing that on a expendable dollars basis as opposed to an endowed dollars
Yeah.
basis, right? Because if the industry or if the approach to paying players changed over 3 or 4 years, then your endowed account would need
Yeah. What are you doing with that?
rewriting or something. So yeah, most most university endowments, basically it breaks down to most of it is scholarships and professorships. There is some that is programmatical, and then the balance is general use. The general use tends to be 20% or less of the distributions to the university.
And you just said the keyword I was going to ask about the distribution. So we're not talking, right? What's the size of Baylor's?
So Baylor's endowment's 2.2 billion.
Okay.
There is a legal requirement across which all universities operate that the operators of the endowed assets maintain intergenerational equity. It's a legal term that means that the same benefit has to accrue to the students today
Hmm.
and the students in the future. And over time, that has generally been assumed to be about a 5% spending rate. If you earned 8% in the stock market over time and you spent 5% sending those dollars back to scholarships and programmatic funding, then you would have 3% left to grow the endowment. And inflation, you know, prior to the last couple of years was kind of 3% for the prior 30 years. And so that 5% spending rate is generally where people gravitate to.
Is another name for that law the anti-Chicago, Illinois law? Right? They're like, okay, we've made -4%. Let's spend 40% and see how things work out.
Yeah, that doesn't really work.
Yeah. Um, and this is who was telling me that Princeton, I think, can cover their entire. I mean, how many endowments? I guess I'll form it in a question. How many endowments out there are actually covering that entire desired outflow?
Yeah, not a lot, right?
Yeah.
Because basically you would have to have donors that gave 20 times whatever the expense was to properly endow it and take it, off of the college's books, right? It was fully
Yeah.
covered by the endowment. So it's a lot of dollars. Um, the people generally ask me, and it would hold true for Baylor, it would hold true for, any other school, Northwestern. I went to University of Chicago for grad school, so it would hold true there. Um, for some of these schools, Northwestern, University of Chicago, the Ivies, the endowments are in, 10 to 20 billion dollars. Does it matter if the next donor created an endowed account? And the way that I always respond to that is I would ask the student who's, receiving the scholarship from your endowed account. I would guess that to that student, it matters a whole lot.
Yeah.
And so,
And that's the
um,
difference between just putting it into the general endowment versus I was a philosophy major at Union College. I'm endowing a philosophy scholarship
right,
in particular.
you can do that, right? So I couldn't endow an account specifically for you
Yeah.
because then I'm getting around, the gift tax thing,
Mhm.
right? So that's not allowed. But I could say for any uh for any union student who is pursuing philosophy as a major, you could even make it more particular
From
and then
Chicago. Yeah.
came, from a place east or west of the Mississippi River, that is actually ends up being a contract between the donor and the university. They legally cannot use those dollars for something else.
Hmm. But then how is that confusing on your guys' side? Just as a practical matter of like, to me, if you're like a huge hedge fund of funds managing all these SMAs,
Right.
right? Of like this has to stay in a sleeve, and I can't have that in some super illiquid thing where I might need to get that out.
If you're right, if I had to keep track of all of those things, that would be very confusing. Thankfully, I don't. So how it works at most endowments, certainly the large ones, is there's development staff that calls people and asks for money. That money comes in if an account is formed. Treasury, the accounting departments at the university keep track of. At Baylor, there are 5,000 line items that make up the
Wow.
endowment.
Yeah.
They keep track of all of those. It gets unitized, so like a mutual fund.
Yeah.
And when dollars come in, they buy units
Of the
in
main and
of the main. We call it the Baylor University Fund.
got it.
And then on the flip side, when we're sending dollars back, those that's just a distribution, just like it would be from a mutual fund. X number of shares are redeemed, and then Treasury takes responsibility for making sure that
Yeah.
all those dollars get to the right account and to the right place. So
So is there a little bit of a hack there, right? If you were in some venture capital fund that's going to pay a big distribution next year, and I came in this year and endowed something, I'm going to get that distribution from that without having
you
lived through the 10 years of investment period, right?
that's true. You would. We of course mark everything to market
Yeah.
as so there would have to be a little bit of you would have to know things on your side.
Yeah.
But
Right.
yes,
Right.
yeah.
But go ahead. Hey, hack it away, people.
Yeah,
Send $1 billion in and get that next distribution.
exactly.
Generally, what's your guys' sort of return target, risk profile, all that good stuff,
Yeah, we
and
don't
portfolio
have
composite? Yeah.
right. Of course. Let me give you some perspective on how we think about the endowment philosophically. We're a little bit like, and most endowments are a little bit like doctors and like first do no harm, right?
Hmm.
The 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 distributions that we provide this year for Baylor, about $100 million. Baylor's budget on an annual basis presently is about $1 billion. So the endowment is covering 10% of Baylor's budget. So from that standpoint, no endowment is going to be all equity, right? Because if we just take the current environment, if we talk about tariffs that are going on, we're unclear, where that's going to sort out. But let's just say that there was a full-blown trade war and everyone just stopped trading with each other. Then in
Yeah.
that situation, the market could be down, what, 50%, something like
Yeah.
that. If that were the case, and if you had 100% of your dollars in equities, then the go forward years, instead of me being able to give the university $100 million a year, now I'm giving them $50 million a year, right?
Hmm.
So to the extent that endowments take on a great degree of volatility, they're putting the future tuition at risk for, you know, for the students who are going to attend the university in the future. And so almost all endowments come at the risk side of things first, right? We're trying to, in fact, in our spending policy, to even make it a finer point, in our spending policy and what governs the distributions that are sent to the university, not only is there a smoothing function that sort of like over the last 3 or 4 years, it's looked back, but we can't send less to the school the next year
Hmm.
than we did this year, right? So there's a floor built in. There's a floor built into the spending policy that kind of keeps floating up. And it's in essence like in hedge fund land, a high water mark, right?
Yeah.
So once we've given the school $100 million, regardless what happens in the equity market over the next year, we're still going to give the school at least $100 million. And the reason for that, of course, is because academia doesn't move at the speed of the markets, and our purpose is to support academia, right? And so if you think about that, and it could be the case if you rolled back and you went through, the 60s or the 70s, and there was a lot of volatility and the equity market just kind of went sideways and something like that. And then you had like a tariff type thing and a big downdraft, you could get yourself into a lot of trouble if you were just,
Yeah.
you know,
Now you're drawing down principal and asset.
exactly
Yeah.
right. And then at that point, you would
Again,
actually be
Chicago,
going.
see Chicago, Illinois.
Exactly. And at that point, you're actually going against the legal framework that these endowments are set up for, because then you're not being true to the intergenerational equity between today's students and tomorrow's students. Today's students would be benefiting at the expense of the future students. So everything on the endowment side is first like do no harm and tends to be risk mitigating, and then within that, you're trying to do the best returns that you can get. And so this is why some of the stuff, like when you're comparing stuff, I could have just been in the S&P,
Yeah.
100%, and that's beat all the internet. Well, it's like not a fair
Right. Or
comparison,
2 billion in Nvidia. It could have solved
right, exactly,
all of
right.
Texas's problems.
Yeah, and it could have until there's a tariff there, and then it's down
Yeah.
50%, and then the school's at risk. So um, I think most people on the endowment side who sit in my seat just don't comment when those things come up. But not only are they laughable, but we actually can't do that, right?
Yeah.
So like if I put the entire endowment in Nvidia, I would go to jail.
Yeah.
So
As you should.
so yeah.
And so what is right to me that lends itself to like we should just be in T-bills. But then you get
And
the zero rate environment, then you're in that problem too, right? So
And
that's the trick.
originally, that's where all endowments were. So it's only been over the course of the last 80 years that endowments have migrated to it used to be stipulated legally that you could only be in fixed income. And then over time, what's happened is that equity allocations have increased and then alternative allocations have increased, right? And so over the industry is changing, right? As things do. And so I would say there are different schools, of course, that have different levels of risk tolerance, kind of obviously, right? So
Yeah.
does everyone. Um,
Different state laws, the whole game, right?
well, each endowment is governed by state law. State law has generally trended to be similar in this regard. And so
Okay.
everyone's basically governed by the same laws. But it might be the case that a school particularly needs to get their endowment higher, and so they are willing to take more risk to make that happen. Or it could be that the school, and this is the same thing with a lot of ultra high net worth individuals, we have a lot of money. We're just trying not to lose it. Right. And so
Yeah.
I mean, we do kind of compare school returns, but that's also specious too, right? Because there's a whole range of risk tolerances and preferences and needs, et cetera, for each different school. So in general, annualized volatility runs in a range from sort of like 10 to 15%. So it's not too different from the equity market. I think equity market kind of over time is 14-ish.
Yeah.
Um, the last 10 years, the top endowments are probably high 9%, 10% returns type of thing. But we're like I can't speak to everyone else's, although I think it's very similar. But to give you some perspective on how diverse our pool of capital is, we're way, way more diverse than the S&P 500. Like it's not even close. And we own all sorts of things. We own makeup brands, we own beverage brands, uh, we particularly own like helium gas, in addition to the energy stuff and what
Yeah.
have you. Well, we own
You're saying like actually have ownership on the cap table of those or own in the public markets,
in the helium case, it's a private company that produces
yeah,
helium gas, and
which
um,
is running out or there's a shortage or something, right?
which is why we own it,
Yeah.
right? So one of our sort of core tenets. One of the things that we try to do is we kind of look at things from a top-down perspective and where are the shortages, where are the bottlenecks in industries where demand is growing. And then we try to own either the companies, the assets, or the inputs around those bottlenecks or shortages, right? And all we're really trying to do is set ourselves up in a situation where the wind is at our back, right? Um, and typically, like in the helium case, like that doesn't move around very much based on what the equity market is going to do, right?
Right.
Helium goes into MRI machines. It's used in semiconductor manufacturing. It's used in rocket launches. So semiconductor usage is going up, rocket launches are going up, MRI machines are going up. Therefore, I want to own the thing that is in short supply. And we try to do that broadly across the portfolio.
I thought it was just huge kids' birthday demand for the helium balloons. It's got
No.
industrial. But you're talking just in the equity sleeve of the portfolio, right?
This would be in the marketable side of the portfolio. So
Yeah.
we divide it into, the private side would be venture capital and private equity and buyouts and anything that has like a 7 to 10 year drawdown fund structure around it. On
Yeah.
the marketable side, it would be fixed income equities and what we call as marketable alternatives. Hedge funds would fall into that category. Anything that was
Hmm.
hedge fund equity like, but wasn't like a drawdown function, drawdown structure, and was shorter dated.
And what do you mean by drawdown structure, where they can ask for more capital?
Correct.
There's
Right.
capital calls. Got
So
it.
in our fund, privates end up being about 45% of the assets. In some of the bigger endowments,
Yeah,
those
or
can
like,
go 60%, upwards of
yeah.
60%. What we have found is that, or what we believe is that the equity market doesn't always go up, and the ability to move, the flexibility to allocate capital into opportunity sets when the market is down is kind of critical. And so we've stayed right around that 45% level, because what we've found is if you go beyond that, then when the equity market goes down, then you have this denominator effect. Then the total private side like kicks up to close to 60%. People are
Hmm.
still calling capital. It's contractual. You don't have an alternative there. And so in that situation, you end up selling some of your public holdings to fund these private, but you're selling it in the whole. And that's what we're trying to avoid. So I would say at any
And
point in time, we probably have more liquidity than we probably need. But then in situations like we're in today, that's very beneficial.
and then out of that whole pie, right? So the marketable versus drawdownable, what does the alts look like? If we
So
put, and well, I guess I'll ask you,
on
how
the
do you,
marketable side, right? So on the marketable side, it'd be about 50% sort of uh, typical traditional fixed income and equity type funds, and about 50% would be alternative.
got it? Which might be, or they still might be, have a beta to stocks,
Oh,
or they're,
certainly. Yeah,
okay, got it.
certainly. Yeah,
So it could be some energy hedge fund, some
correct.
specialty China tech or something.
Correct.
Um, and then what I would call true alternatives like macro or managed futures or long volatility that would do well in a market downturn. What does that allocation look like, if anything?
Yeah, so that depends, and that's varied quite a lot for us over time. I can take you back through it a little bit. Going into 2020, I mean, we didn't know that there was going to be a pandemic, but going into 2020, we had about 15% of the endowment in cash and long volatility.
Hmm.
And that really came about because 17, 18 volatility was basically the cheapest thing on the board. And so,
So you warehoused it?
yeah, we were buying it, we owned it. We probably went into the pandemic with about 80 million in long vol products, which was up about 65% over that, the second, I guess, March, April,
Yeah.
and May of 2020, at which point we sold it and rolled that into equities that were down 30%, right? So,
Fantastic. What did that look like? That was predetermined monetization, or it was just, hey, this is crazy. Let's do a emergency meeting and come out with
yeah,
a
so we
rebalance.
have the wherewithal, the staff has the wherewithal to move money around within percentage guidelines for each fund. And so, like, we all know that VIX doesn't stay at 80 for very long. So
Yeah.
if and when it's north of 60, you better be getting after it. um so yeah, that's I've traded vol before, and
Yeah.
it's just kind of
And
what you
was
do.
likely going outside your band anyway, right? So if you were,
It wasn't. We didn't have that much.
hmm,
I think it was 0 to 4 or 5% that
got it.
we could allocate. And at the time, it was we'd probably allocating, oh, I don't know, 3%, 2 to 3% at that. Um, and then as 2021 rolled on and stocks were going straight up, we sold equities. We bought long vol again. We started
Hmm.
stockpiling cash. 2022 happened, which was the tech meltdown. Because it wasn't an existential thing, vol didn't rocket up like it did during the pandemic timeframe, but it was up 15%. We sold that. We bought equities. And then, yeah, we've been pretty long equities up until about the fourth quarter of last year. And we took equities down by 5, 6 percentage points. So
It's a
at the
good call.
moment, we have the least amount of long only equity exposure that we've ever had. So we're fairly sanguine about what's going on in the market these days. It doesn't meaningfully impact us. We have over the last 2 to 3 years been allocating a lot more to idiosyncratic type things like helium, right? That doesn't move.
Yeah.
We own via another manager, we own three Class B malls across the US and one in the UK, right? So there would be another example of endowments being much more diverse than just what the S&P 500 is doing. So um, yeah, I mean, we're
What
involved in all sorts of things as it relates to our exposure right now. We have the least amount of equity that we've had. I'm kind of happy to maintain that lower equity exposure for the time being. We have a number of things that are more idiosyncratic that are doing quite well and kind of bolstering our returns outside of what the equity market is doing.
and any trend following managed futures exposure?
We do have some, not a lot. We actually have it paired with some of our tech long only exposure. So
Hmm.
we think about where our risk lies. And then, of course, we're trying to mitigate risk. And so let's see, on the long only equity side, we probably have about 10% where we've hedged it. In addition to just having not a lot of long only equity exposure, about 10% of our equity exposure is hedged. Some of that is hedged with trend following. Some
Which
of
is,
it is hedged with long vol. So
yeah,
we're trying to mitigate both the 2022 scenario where it's just the valuation drip, drip, drip,
yeah,
for the whole year. But we also want to mitigate some of the, oh my gosh, existential risk, pandemic happens.
yeah.
And so the
Quick,
combination of trend following and long vol serves that purpose.
And how do you personally over the years deal with trend following drawdowns, which we're in a pretty good one right now? Hasn't delivered. It's been way too choppy and whipsaw.
Right, exactly. Well, we don't own things. We are not a set it and forget it shop. So we started adding trend following actually Jan 1.
Hmm.
So we've had it in our book before in the past, but then there was a long period of time where we did not. And we've just added it back because equity valuations were high. We didn't know how they were going to come down. And to your point, over the last quarter, trend following hasn't worked to mitigate that down move that we've seen in equities, but the long vol bit has.
And so you would get in or out of it, not based on its own performance, perhaps, but based on the
Correct.
greater picture for you.
Correct.
Now equity's super cheap. We're gonna get rid of that hedge, move
Correct.
back into
Right.
equities. Interesting.
Exactly.
Yeah.
In other words, not everything needs to be hedged all the time.
Right.
Right. In general, our view is the endowment can withstand a 10% down move. It gets really difficult for us if the equity market were down 40%. And so we hedge things sort of 10% and beyond. We're not, if the market's down 5%, we could really care less.
Yeah. So let's talk. We're recording this, had a super crazy week
Mhm.
last week, which we'll say for the listeners this week, recording on Friday. But what, not losing sleep at all, just of interest? Are you staring at your screen going, this is crazy? Like, what were your main
It is
takeaways from
crazy.
this
I mean,
week?
it's historically crazy, right? The vol that we're seeing, up and down 5% in a day is about 10x normalized vol. So, like, it's for sure crazy. Um, we were very attentive over the weekend as to what was going on. It wouldn't have surprised me. Of course, the markets opened Monday down another 5% and then
Yeah.
kind of rebounded, but you don't know. I mean, uh, when futures were closed, we were watching Bitcoin because it trades around the clock, of course, and it was down 5-7%. So on Sunday, I was touching base with all of our managers saying, like, if we're down 10% tomorrow morning, how do you do?
Yeah.
And then preparing for if that was the case,
What
who
are
or
you
where
gonna
would
do?
we allocate to take advantage of those lower
Hmm.
prices?
But
Uh,
you're not thinking, where am I ditching risk and this kind of thing and deleveraging? You're thinking, where can I get
no,
into things?
no, and the endowment itself is not leveraged, right? So the individual managers can take on leverage if they
Yeah.
want to, but
De-risk, I should have
the
said.
whole
Yeah. But
thing
yeah.
is not. No, we tend to do the de-risking bit, like I mentioned, in advance of a lot of these things. So if something doesn't make sense to us, we we lower our exposure, right? If the Mag 7 being at 30 times earnings, that doesn't make sense. So you know we have very little exposure to those names. I don't think we've ever owned Nvidia, for example.
Hmm.
um, so that helps us avoid divots, which if you go back to, the central thesis of what an endowment is about, that's the primary thing that we're trying to do. We're trying to avoid divots and then invest after the dust clears. And so it's worked so far over the last 10 years. So we'll see if it continues to work, but we try to get out of the way of things that don't make sense and then allocate quickly in behind them when they trip and stumble, fall on their face.
Any, as you were watching the screen, any major concerns that bonds are in big trouble, US dollars in big trouble, like that the US is in trouble, right? If that's no
I
longer
mean,
a flight to safety, I don't know what
yeah,
your
that's a
duration is on your fixed income side, but like kind of how
that
you think about that whole piece of this new puzzle.
right. I think what's going on here on the bond side, rather than anyone sort of manipulating, bond yields, is if you think about it, we basically had, let's just say that the scenario that I gave before, it's metaphorical, but we can work with it. Say everything that is imported costs 100% more, right? And that's the way things were going to be. Then the
Yeah.
stock market in that scenario is down what? I don't know, 35%.
Yeah.
And that would make sense. Then you had a 90-day pause. You're just going to hit pause, except for China, which is what, 20%, 15, 20% of our
At
trading
least.
value.
Yeah. Yeah.
And it's up, the tariffs on that are 125. Well, now they're 125. I don't know. They could be 150, whatever, right? Let's say all the other ones come to some sort of agreement. And then you divide that 125% by 20%. And so, like, basically, on average, everything that you buy that's imported is, costs 20% more. Well, that's clearly inflationary, right?
Right.
And I think that that's what
Long
I
term.
think
Yeah.
this expected value of inflation is what the bond market is doing, right? So I think that the administration was able to keep sort of 10 years locked down, if you will, until this tariff bit. And then people just start doing expected value math, which is not very difficult,
Hmm.
and are going like, yeah, it pencils out to be up 20% for everything, right? So then the back end should lift. And that's kind of what we're seeing.
No, and I was on a pod last week theorizing maybe it's the end of trust in the US markets and especially the US Treasury market of like, I don't know which
Well,
way these guys are going. They're
yeah, that I
on
mean,
again, off again. Is there maybe a little bit of the
certainly,
bid? Is
certainly
that
that's, the foundational requirement for the functioning of financial markets is trust, right? And that's why economists, of course, are saying that the damage has already been done, because if I'm a CEO and I'm making $20 million a year, making whatever it is that I make, and I have the ability to ask my board to spend $500 million building a new plant in the US, am I going to do that? No,
yeah,
because it's going to take 3 years to build that plant. And in year 5, we might have a new administration that changes the rules again. And so then I get fired because I spent $500 million on a manufacturing site that now has no use.
in the most expensive spot in the world. Yeah.
So our is manufacturing coming back to the US? No, of course not. Right. Now, will it go to other countries like other than China? Yeah, it will, and it already has, right? Hence Vietnam being a target, right?
Yeah.
So that will continue to happen. I would not want to be a supply chain vice president right now. I think
No.
that's realistically the point of the spear. But yes, when you've sort of had the rug yanked out from under you, and the decision makers are people that are making, 10, 20, $30 million a year at the top of these big companies, do they want to risk their income to potentially spend, you know, 200 million, 500 million to build a factory in the US? No, of course not. So,
That's a good. I haven't heard that take before. It's like not because it's bad for the shareholders, but probably also bad for the shareholders.
yeah,
But they're like looking after their own skin.
of course.
Yeah. Um, right. They got to pay the homeowners fees on that house in Jackson Hole or whatever. They can't be getting rid of that $20 million a year.
Right.
Talk for a minute. We touched on a little bit. Is it hard for you or hard for endowments to write everything we just talked about is kind of short term, but you have this super long term view. So right, like you have to transact and you have to act in the short term, but you're having as you said, 7, 8 year view. So
Right.
like, is that mentally difficult for you guys
I think it takes,
or
I,
helpful? Yeah.
I, to me, it works very well. So and let me give you some perspective around that. I would be a terrible floor trader, right? Like in the pits in Chicago, I simply can't process the change that fast and make a decision. I would be penniless and hungry if I had to be in the pits in Chicago, right? That's not my shtick. Likewise, I'm not a very good trader as it relates to what our next quarter's earnings going to be. There are a lot of the pod shops that are like really, really good at that. That's not kind of my shtick or my strength. Um, I prefer to think in a top-down manner over the course of 6 months to 3 years. And the endowment space actually suits that type of thinking very, very well
Mm,
because we can lean on longer dated. We don't have to have returns today, right? Like pod shops have to have returns today, right?
yeah,
Otherwise, the capital
literally. Yeah.
leaves. I don't have to do that. We own our capital. Our capital isn't going anywhere. And so I don't have to worry about making money today. And therefore, I can lean into things that are dislocating and might take, 6 to 30 to 36 months to work out, right? For myself, once you get beyond sort of 3 years, I'm like, who knows, right?
Mm,
Like I don't know if Israel and the countries around it are still going to be at each other's throats. I don't know if Russia and Ukraine are still going to be at war. Like it's like that's too far for me to see. But over the next 2 to 3 years, I think I think it's not too difficult to ferret out like where things are headed. And then we invest around that. If we were good at predicting where things were, 7 or 8 years in the future, then we would do the cyclical bits on the private side, right?
yeah.
Because we would be able to be like, I know that in 7 years, crude's going to be at 30 or 120, and then we would invest that way. I don't, and so therefore we don't.
And do you think, right, this kind of leads, I guess, to why an individual, there's a lot of family offices are trying to adopt endowment models, even some individuals, but is that a mismatch, right? Of like, if I put an endowment model in my 401k, maybe that works, but in my kid's college account, probably not, because I'm going to need all of that money
Right.
in 6 years or whatever.
Family offices are interesting because the families themselves actually play quite a big role in how the investing goes. Now, it depends on one family to the other, but the central thesis with all family offices is that obviously the family has done something right.
Yeah.
So whether it's in energy or real estate or owning a company, et cetera, the family has been involved in business previously. They know how to make money, and they've actually been extraordinarily successful at whatever it was that they were doing. And so, a little bit by definition, you in that case are working for someone who, to some degree, is potentially better at the money making bit than you are.
Uh, yeah.
And so, from that sort of foundational underpinning, family offices often, the investment professionals that work there, tend to have more of a dialogue with the patriarch or matriarch of the family who has gotten the family to that point, to that financial position, more so than exist in the endowment space.
Right.
So we
There's no
meet with,
Mr. Baylor. Yeah.
correct. We
Or
meet with
Mrs.
our board quarterly. And in between those times, they're available if we have a question or a concern or need some assistance with something. But otherwise, they leave us to implement the plan that we've talked with them about previously.
I'd push back a little on. Sometimes the family office uh patriarch, whatever, is has the like entrepreneurial trap, right? They think they're
Mhm.
good at all this other type of investing because they've had all this success, but it's doesn't correlate necessarily.
Yep, that's true. You get that a little bit with doctors as well, right?
Yeah.
Doctors, doctors are used to being the expert in the room and saving people's lives, and that doesn't necessarily translate to finance.
And then my experience in Texas is you got a lot of family, a lot of oil money that wants to
Mm-hmm.
just keep doing oil money.
Mm-hmm. Yeah.
Um,
And so in that, from that standpoint, we know a lot of family offices around the state, of course. And from that standpoint, the investment staff then are taking exposure that's significantly different than what we're doing because they may have a company, a business, an asset, a sector that like dominates the family's wealth. It might be 50% or more
right.
of what governs that family's financial situation. And so they actually then wouldn't invest at all in energy on their own because they already have this big, oil asset over here.
Way in the beginning, we mentioned some of the private stuff has issues.
Mm-hmm.
You want to elaborate on that? I think we touch a little bit on it of the drawdowns and then to ask if in this, right, what are Nasdaq's down 20% off its highs? Are you starting to see some privates not do distributions, all that kind of good
So
stuff?
let me answer the first question.
Yeah.
You know, you've seen this from from Congress or from the regulators, is that basically there's been more focus recently on the transparency of what the management company is paying for and what the LPs in private
Hmm.
funds are paying for, and making sure that if the LPs are paying for something, that that is then disclosed, right? So, in the pod shops, for example, those are often sort of like cost in 20 types of things. So, like almost
Yeah.
all costs can be rolled into that. That is
Yeah. There was a
not
big article, it was like 50% or something, right?
right. The private funds are not set up as cost in 20, but if the principals at the fund do consulting work for one of the companies in the portfolio, there's a question of like if that consulting fee,
Hmm.
like where that goes, or does that
Yeah.
get backed out against um, management fees that the LPs would be paying anyway, right? So there, I think that the just like any industry, as it grows and gets bigger, it gets the attention of regulators, it gets the attention of lawmakers, and it wouldn't surprise me if there were more transparency requirements around all of the cash flows that are going back and forth between portfolio companies and the management company, for
Which
example.
is weird in my world of regulated futures and commodity pool operators. That's already in place. There's all
Correct.
sorts of
Right.
regulation.
And that
Yeah.
was, and your business was around much earlier than,
Right.
the
Yeah.
buildup and growth in the private fund universe. And so it's not a surprise, right? The regulations and whatever that exist in your world at one point didn't exist. And then there were some bad actors, whatever, and then there were regulations around that, et cetera. This happens in every industry. And so it wouldn't surprise me if more of that is forthcoming on the private side.
It'd be bad for the private jet industry. They can't, well, I need this jet to fly out and see my private company in the
Yeah,
middle of Michigan. And how else am I supposed to get there?
yeah. I'm not
No
sure where that
comment.
would land.
Yeah. And then because you mentioned pod shops, you guys invested in some pod shops, and there's been a little bit of like they're getting too big. I guess it's kind of what you're saying, but what's your thoughts on that as a
Yeah.
strategy and where it fits kind of in a portfolio?
Yeah, there's a number of things that we don't do. That doesn't mean that they are bad things. They're just, we can't do everything, and we have a particular strategy and approach to doing things. We don't do private credit. We don't do
Hmm.
pod shops. At the end of the day, we are effectively running what the pod shops themselves are running.
Right, right.
And we feel capable of allocating capital between managers and strategies on our own. So we don't feel like we need that additional help, if you will.
You don't have a center book. Like, if one of them are on here, it'd be like, well, the real strength in it is having a center book and offsetting risk in real time and yada yada. But
Yeah, I think if you plot all of the endowments, risk and return, um, I don't believe that there are any endowments in the country that have our same level of risk and higher returns.
really,
So we're doing
love it.
just fine on the risk adjusted side of things.
Yeah, we don't without a center book. We got it.
Yeah.
Um, awesome. We're gonna end. I forgot to say before when you were talking about all the rankings and you look at the other endowments performance every year. I can't remember who puts it out, but they put out a graphic of the Ivy League's performance,
Mhm.
and it drives me crazy because it's not color coordinated. It has Dartmouth like red,
Mhm.
and all the colors are different colors. I'm like, how easy would this be to just put the school colors on each
Well,
of
the
those?
interesting thing is that in the Ivy Leagues, because the endowments are generally quite large, is that within the Ivy Leagues, every student newspaper up in the Ivy Leagues
Yeah,
produces that graph that is color coded,
yeah, yeah.
right? Because
Nice.
they're keeping track of how they're doing versus the school up the road.
Yeah, what's the average in the Ivies now?
In
35,
terms of
40 billion?
size,
Yeah.
I don't know. I think Brown is the smallest at around 8.
Hmm.
So I
And
mean,
Harvard's like
Harvard's
50
like
something.
60.
Yeah.
So yeah,
And what I was saying before, I heard Princeton has hit that place where just their distributions are covering the entire school.
I think that's
It
true.
was on a podcast. I can't who's the thinking fast guy? But he was saying like stop giving money. They don't need any more money. He's like give it to your kids, do something else. Stop giving them money. All right, let's finish with something fun. Do a little Mount Rushmore. And let's ask your favorite bands. What 4 bands would you put on your own personal band Mount Rushmore?
All right, so you know, I grew up in the 80s largely, junior high and high school. So the bands of choice at that time were Van Halen, Def
Yes.
Leppard, U2, The Cure. So the 80s station on XM or the 90s station is generally what my car radio is always on.
Got it. So that right there, that's your 4.
Yeah.
Same again was Van
Van
Halen.
Halen,
Couldn't
Def
agree more.
Leppard,
Yeah,
Def
I'm gonna
Leppard, U2,
U2 for sure. That's my number 1.
and The Cure.
And The Cure, right? A lot
Yep.
of U2 in there. I'd put The Cure on there. I went to see U2 in the Sphere in Vegas.
Oh,
It
very good.
was phenomenal.
My wife and I
Um,
went to the 30th anniversary Joshua Tour
yeah,
concert when they
in
when they were
Chicago,
doing
in
that a
Soldier
number of
Field.
years ago. Up here in Dallas at the
Nice.
American Airlines Center. Or
Yeah,
no,
that
I
was
guess
cool.
it was at Jerry World. It was at the Dallas Cowboys Stadium.
I still haven't been there. That's super cool.
Yeah.
Hopefully we're getting one of those in Chicago soon when they move the team out to Arlington Heights. I'd be fine with it if they build a big, huge, cool stadium like that
Yeah, of course.
and get some better teams.
Right.
All right, Dave, this has been fun. Thanks so much.
Of course.
And
Thanks for having us.
keep fighting the fight down there.
Yeah, we're trying.
All right. Thank you.
Cheers.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.